Hi, I'm Ethan Devitt, and welcome to this week's Markets Happy Hour podcast. This is coming to you live from Mendoza in Argentina. We are in the middle of a 3-week trip down here and have just spent 6 wonderful days in Santiago, where we met with many industry representatives and discussed the economy on the ground there. So we will bring you a report direct from there at the end of this podcast, as well as a few statistics on Chile, a country in South America that is bucking the trend, certainly in terms of growth and economic resilience. Let's share the slides and get straight into what has been a very active week in terms of news flow, with some unprecedented headlines that markets had to grapple with, as well as an ongoing divide between the haves and the have-nots when it comes to US equity markets. I've called this week's podcast Resilience and Retreat, as this seems to indicate this divide between markets. We're seeing some markets particularly resilient and some in retreat, both in terms of investor appetite as well as the actual behavior and performance of those markets, particularly as the cleavage in performance from high-tech stocks and the old economy stocks continues to percolate. I've shown the picture of Santiago in the winter. It was beautiful with snow-capped Andes behind the skyscrapers, and that to me is a beautiful juxtaposition of the old and the new that city represents. Moving on, as usual, we're going to speak about inflation and economic vibes or activity, interest rates and what the change in economic activity, particularly around labour, may mean for interest rates. We'll discuss equity markets and the increasing concentration that we're seeing there. And then we'll move to geopolitics and other, particularly the impact on the dollar. And we'll have a small section dedicated to Chile at the end of this podcast. In terms of the storyline, we do, of course, have a problem with statistics, and that was what kicked off the week when the labour figures were released last Friday. We will ask if maybe now is the time, because of these labour statistics and because of other indications of slowing of the US economy, for interest rates to fall as they have continued to fall around the world. We will discuss a very positive earnings season overall and suggest whether a new paradigm for market concentration is emerging. And then, as I mentioned, we will go on the ground to a guest speaker from Chile to discuss what the current Trump moves around tariffs and changing foreign and economic policy means for countries such as Chile, a big exporter to the US. Looking at jobs, clearly the jobs figures last Friday were disappointing. There were both a very low jobs number for the 1 month, as well as revisions downwards of the past 2 months. And this indicates the weakest 3-month job growth since 2011. Clearly not the news that markets were expecting, sat at odds with what has been a remarkably resilient set of economic data in the run up to this. And in the immediate aftermath of this, there was a reaction from the government which suggested that these statistics had been doctored, were not to be believed, and there was an immediate firing of the head of Labour Statistics, Erica McIntyre. As we can see, markets did not react well to this move. There was a suggestion that if these statistics could not be trusted, perhaps what statistics could be trusted, and that could undermine trust and confidence in anything that emanates from governmental agencies, and certainly could undermine trust and confidence in what was a resilient economic showing up to now. We can see that if we look at the movement of the dollar in that one day, there was a body blow, as it was suggested, to the dollar, and that the high-profile departures in the immediate aftermath of that, not only the resignation or the firing of Erica McIntyre, but a subsequent resignation of one of the Fed governors, which then suggested that there would be a Trump appointee next in line. These both had a weakening effect on the dollar in the one day. We spoke last week about the escalation of tariff wars as the August 1st deadline neared. We are now a week past that deadline, and we have seen a real increase in tariff rhetoric over the past week. In particular, in the firing line have been Switzerland and India. Switzerland, a somewhat unusual case, as it has generally had a trade surplus with the US. As we can see, the deficit for Switzerland has been quite recent and has been driven by gold flows, and this in particular seemed to be a target of the tariffs. At 39%, Switzerland sat apart from the general EU tariff, which had been inked a week before, and this led to a flurry of diplomatic activity and a desire to eke out a new trade deal between the two countries. India has also come under the firing line because of its relations and oil trade with Russia. The tariff there has been increased to around 50%. So clearly a departure from the previous solid relations between the US and India. And we know in particular now that pharmaceuticals look to be next in the firing line, and that this could have severe repercussions for countries such as Ireland, which export a lot of pharmaceuticals to the US. We can see that this has had a direct effect on the pharma index, which we can see here on the right-hand side. The Stocks Europe Pharma Index in black has been falling dramatically as tariff news flow increased, as the levy threatened on pharmaceuticals has increased to 250%. We can also see that the Nifty 50 Pharma Index, while somewhat weaker, has not fallen by as much as the European stocks. So clearly the European stocks very much the losers in any of these tariff negotiations, certainly if the threatened tariffs are to come to pass. When it comes to interest rates, it seems that now the only way is down, particularly with the weaker labour statistics and evidence. We know that Stephen Moran, as Trump appointee, been now appointed to the Federal Reserve Board. He has been very firmly in the support of President Trump. So clearly we know that his vote will be for a downward trend in interest rates. And we also saw, just in terms of global trends, the Bank of England dropping its rate again to 4%, although that was a narrow vote that had to be taken twice. So clearly some division in terms of the wisdom of an interest rate cut at this stage. The reason for the hesitation in the case of the Bank of England was still stubborn inflation data that is looking to be quite persistent in the UK, as well as the slow economic growth, that concern around stagflation continuing to mount. But certainly in the US, it does seem like when it comes to September, the next rate cut will be inevitable. And the suggestion now is that it could even be a double rate cut, or one of 50 basis points, as we saw in the past, particularly due to the shock weakening of economic data. Otherwise, though, if we are to do our summer vibe check, the vibe session seems far in the past, as we know that we're seeing quite a bit of surge around tech stocks. We've also seen cyclicals do very well, and that basically cyclicals, because of their leverage to the components around AI and around the picks and shovels, the data centers, etc. We know that they are now looking quite strong relative to defensives, and that their dot-com era dominance is now being repeated. So if we look at this chart, we can see that interestingly, cyclicals relative to defensives have never done as well since 1999 as they are doing currently, and we can see that the way is quite strong in terms of the upward direction. Spending, that was certainly a big hallmark of this month's earnings releases, and we can see that the spending on capex, particularly when it comes to the large tech stocks, is certainly on the rise. Google, Amazon, Meta, Microsoft, Oracle, all showing significant 12-month trailing capex numbers that are increasing as a percentage of US GDP and increasing in absolute terms. So very strong indications of not only the cash flow rich nature of these companies, but their bold spending initiatives, which are likely to drive increased momentum around these stocks. On the other hand, we have oil still quite low, whether that relates to low anemic demand around the world, or certainly the OPEC half-hour meeting, which did decide to increase supply. So supply-demand factors clearly also affecting oil. That the one factor when oil is this cheap, it does embolden the ability to threaten boycotts around Russia when crude is near a 5-year lows, and enable that to be a pressure point that is put on Russia. What we can also see, though, is that in terms of the desire to do more drilling in the US at oil prices is slow, it is difficult to encourage drilling when the margins would not be meaningful and essentially the costs just don't make sense. Getting back to an issue we raised before, which is around the increased concentration of US markets. This is something that markets haven't really contended with before in terms of what it means for active management, what it means for the growing beta in a portfolio. There's some interesting charts this week that appeared via Bloomberg columnists, but ultimately came from D.E. Shaw. We can see that the largest, whereas concentration in markets are not new, and there has been a lot of analysis in the past looking to the fact that in general, most of the returns from equity markets have come from about 89 or so stocks. So clearly it has not been the thousands of stocks in the index that have driven returns. They've always been driven by a small number of stocks. However, if we look back to the recent years, we can see that the risk contribution of the 10 largest companies within the S&P has been significantly higher in terms of its contribution to risk. and in terms of the weight that they represent. But there is a disproportionate rise in their risk contribution, suggesting that as these companies gain more weight, they start to take on a disproportionate amount of the risk of the index. And the second chart shows that the beta of these top 10 stocks is significantly higher than the rest of the index. Some of this may be circular reasoning, that we know that market cap weighted indices will obviously hold more of these stocks, which will mean that these stocks will increasingly start to look like the market and will therefore start to exhibit more beta characteristics. But the point is that increasingly it will be hard for alpha to be generated in comparison to a very large beta-driven market such as this. We can see here also that the equal weighted S&P relative to the main S&P has continued to slide, and that the Russell value relative to growth has continued to slide. So overall, growth is the dominant feature. We know that it's growth and large caps tech stocks that are the dominant feature, and this is starting to distort markets. We don't yet know how this will look when it comes to our year-end update on how active managers are faring, but we do know that it is increasingly more difficult to outperform a market that is dominated by 10 or so stocks. And we will also, when we look to our emerging market analysis at the end of this, ask ourselves, when top 10 stocks can completely dwarf other world economies, what does that mean for America first, American exceptionalism? And what does that mean for the ability to eke out returns? Does it mean perhaps that one can double or treble their money in less efficient markets, because those are the markets that are more overlooked and therefore have more potential for upside? Or will technical factors dominate, and will it mean that increasingly we will have to hold assets only where the flows are heading, which, as we know, is increasingly into large cap stocks? Another fascinating conclusion from the very strong performance of equity markets was shown by GMO, and there's a statistic here showing that while the S&P and NASDAQ have since Liberation Day shown returns of 27% and 38% respectively, so still in their own right extremely impressive performance numbers, and in their own right would be quite defensible to hold those alone. We can see that this particularly strong performance has driven a hunger for even stronger, more speculative performance. And looking across the spectrum of what GMO has gathered, we can see that unprofitable tech names have led the way by returning 57%. AI-focused stocks, so thematic funds, have recorded returns of around 60%. Shorted names, heavily shorted names, 68%. Meme stocks, 77%. Quantum computing, 84%. Innovation, so high profile, high octane innovation ETFs such as ARK and Bitcoin sensitive stocks are up 112%. So it seems that markets' risk appetite is growing, as even the returns are very respectable 27% or 38% in the case of the mainstream indices are no longer considered enough. And I would suggest that this is exactly why we have seen so much cash on the sidelines chasing equity. As if the general appetite for risk is increasing, then the marginal appetite for risk of perhaps the more moderate investor is also likely to be higher. And that's why we do see this flood out of fixed income into equities, regardless of the fact that fixed income has been somewhat solid in its own right. The growth potential, the allure of growth has simply been too high. Another vibe check in terms of the US dollar, and if we look across the board, there has been an uptick in the US dollar just in the last week or so, as we've seen the stronger performance of the US markets with the confidence around the trade negotiations and just some more strong man rhetoric and American exceptionalism at work. However, we can see that since the election, there has been generally a downward trend, and even this latest uptick brings us nowhere close to the peak that we saw at the end of 2024. Other news items this week were interesting around the increased diversification that is likely to happen when it comes to retirement plans. We know that there have been significant tailwinds around digital assets as part of the Trump administration, And we now are seeing that there has been at least an order, an executive order, to encourage authorities to look at opening up retirement plans to crypto and private equity investments. We know that that trend around private equity investments was already well overway, if not for retirement plans, certainly when it comes to private wealth and individuals. And another interesting headline here was that one of the largest LBO firms, KKR, has tried to recut deals with its big backers, meaning its large institutional investors, in order to allocate a higher percentage of its deals to its evergreen funds that are generally targeted to the high net worth investor. We've spoken before that these evergreen funds have actually proven to be extremely popular, not just with individual investors, but also with institutional investors who've liked the idea of being able to avoid a continuous commitment scheme into private equity, having an evergreen fund and essentially a one-stop shop for all exposure to private assets that does not require continuous weeding and gardening that a main private equity portfolio would entail, has actually proven to be very popular, perhaps to the surprise of some of these issuers. So they're now looking to see an increasingly large share of their funds be allocated to these areas. So I would say watch the space. We are seeing an increasing allocation to private assets coming from the very smallest investor. And this may provoke more regulation, but it may also provoke some unintended consequences, as some perhaps of the risk reward of these asset classes are not always taken into account before they are put into retirement plans. Before we move to the non-US investing, we can see that there was an interesting chart around the net international US investment position. Clearly, there are still far more foreigners holding US assets than US asset holders holding non-US assets. This has been a trend that we've seen increase, certainly in the last 15 years, when we've seen a severe underperformance of non-US assets relative to US assets. As the US economy has grown, as US exceptionalism has been made clear in terms of the equity market performance, we've seen an increasing amount of home bias on the part of US investors and an increasing desire to gain exposure to US markets on behalf of international investors. So if this is a deficit in terms of a net international investment position, it's only growing. I don't see anything that would cause this deficit to reverse. We do see a slight uptick in the interest in international diversification from US investors, but I would say that this is only going to continue, particularly as that concentration in markets we discussed continues to grow. And where would this perhaps home bias, if it does get diluted, where would we see this happen? We've seen, just, and this is actually an older chart around emerging markets, we've seen a suggestion that emerging markets, this is the time that global volatility is a reason to lean into them, as emerging markets are continuing to show resilience. They have experienced inflation as we have before. They are experienced with that. They have tested their institutions. They have proven the importance of having an independent institution such as the central bank. That is something that was perhaps not taken for granted in the US in recent months, given some of the rhetoric. They have learned how to monetize their commodities, monetize their natural resources. They've learned to diversify their export stream and their international exposure, and their domestic investor base is growing, their pension funds are growing, there is an asset management industry, and there is an ability, therefore, to issue bonds in local currency, which is reducing the dependence on US dollar for their domestic issuers, which is a critical piece of being self-standing, resilient, and able to withstand some of the moves in their own currency versus the dollar. So all of these fundamental changes are certainly affecting emerging markets, and there has been some suggestion that there should be essentially more of a broad look at these emerging markets and less bucketing of them. We know that their borrowing premium over US has fallen to their lowest since 2007, and that overall the debt spreads for the top rated emerging markets have fallen. However, we did see a little bit of strength in the emerging market currencies, but that now seems to have reversed in July. This chart here shows how the emerging markets foreign exchange has performed versus the dollar. We saw that in April, May, and June, there was a little bit of a rise against the dollar, as the dollar had shown some weakness, but just that most recently this has fallen. I would suggest this is a direct result of the trade negotiations and a really indication of, certainly when it comes to areas such as Brazil and India, that the US is able to flex its muscle effectively, and that some of these economies don't really have much standing in their ability to withstand tariffs. Some of this may be headline getting in the way of the detail, as we know that in the case of Chile, which we'll discuss in a minute, there has been much more diversification of their dependence on the US, and some of these emerging markets are actually stronger in their relationship with China than they might be with the US. So their exposure to US tariffs is perhaps not as high as might have been thought in the past, but still we are seeing an erosion of the confidence in emerging markets continuing, and that this was only more likely to shore up the sense of US exceptionalism. Let's move now to Chile with a quick overview, because at the end of this podcast, I will show an excerpt from a video I made on Monday with Jose Manuel Silva, Chief Investment Officer at LarrainVial Asset Management. The question I asked him was regarding the exposure of Chile and other emerging markets to the changing economic dynamics now that President Trump has put into effect his tariff scheme. And because Chile, being a big copper exporter, is clearly exposed to copper prices and tariffs on copper, I'll ask how that economy has been exposed to that and to the changing mood music around economic relations when it comes to the US and Latin America. But first, let's look at a few stats regarding Chile. So Chile is considered one of the more stable and economically strong countries in Latin America, with a population of 20 million. Its track record is having sound economic policies and robust institutions. Its GDP growth is somewhat modest, but still respectable, 2.6% in 2024. Rising mining exports, particularly around copper, lithium, and rare earth minerals, has been a big part of that. Its unemployment is still high at 8.5%, representing a slight decline, but not as low as it was in 2019, pre-COVID, which was around the 7% number. This number is still, of course, quite high in compared to the rates we're seeing in the US currently, where we're almost at a full employment number and unemployment has been persistently low. We're seeing investment has fallen by about 1.4%, consumption by about 1%. So still quite anemic, a sign that perhaps despite this strong economic growth, there has been some slowness on the domestic front. There's a high degree in labor informality, so that has been higher for women, 28.4%, 24.8% for men. Inflation at 4.3% in 2024, still above the central bank target of 3%, but not at some of those very high levels that we would associate with other emerging markets. We do expect inflation to be higher in 2025 due to short-term cost pressure and the geopolitical risks around Chile. Some of them would center on the November 2025 election, when we know that the left-wing candidate that has been pre-selected in the primary process is a member of the Communist Party. So likely to be quite a set of extreme comparators when it comes to the election in 2025. So that perhaps presents some uncertainty. And I'll now sign off on this podcast and leave you with a 6-minute excerpt from an interview I held on Monday with Jose Manuel Silva, who is the Chief Investment Officer at LarrainVial Asset Management in Santiago. He has significant experience working across the corporate landscape in South America, and I asked him about his insights regarding the likely impact on Chile and other surrounding countries from the changing trade policy that we're seeing in the US. Thank you for joining us. I will see you again next week. We have a special guest, David Kelly from JP Morgan. I'm very excited to share insights with him and to discuss his views on the economic landscape as we see it. Thank you, everyone, and see you next week. So clearly, we've been speaking a lot about the US and its economic trajectory. And now we have this unprecedented tariff trade war, copper prices being under the spotlight. Certainly when it comes to Latin America, Brazil seems to be a target, given some of its perhaps even political and judicial actions there coming under higher tariffs. How would you say Latin America, and maybe Chile in particular, are dealing with this shift in the US trade policy, foreign policy, and how do you think that is affecting the region?
Well, probably it means that everybody's worried because at the end of the day, always the U.S. was the example of free market, and to do these free market reforms that the region has done in the last 25 years, 30 years has been very hard, very difficult. So now we have the doubt if if this example of what's happening in the US could eventually jeopardize all this effort of decades and efforts which are still going on. As I mentioned, for instance, Brazil is still privatizing companies. Argentina wants to privatize companies. Chile wants to keep, it's very, very advanced auctions in highways, and so there is a doubt. But on the other hand, my guess is that the US needs Latin America. Because there is a probability that the world will divide itself in blocks. The US government speaks a lot about the Western Hemisphere, and the Western Hemisphere includes Latin America. So the US needs Chile's copper, Chile's lithium, Peru's copper. Even in Chile, we have a project of rare earth down south. So we discovered, actually it was a LarrainVial fund, a mining fund of LarrainVial that discovered rare earths down south in Chile. It has been difficult to get that project up because Chile in the last 10 years has become a country with a lot of permits. We have lost somewhat our free market punch. But anyway, we have rare earths. There are rare earths also in Brazil. I would say that the US industry needs part of the auto parts and industrial parts that are, built in Mexico and eventually in Brazil. As I mentioned in Marin's podcast, Brazil has a very sophisticated industry. They export planes. Embraer is exporting planes, and you can see many of those planes in the U.S. airports. So really, I guess that the U.S. needs Latin America, and sooner rather than later, I would say that the U.S. elite will realize that, and of course that they are worried about the Chinese and Russian influence in the region. So if they want to keep that influence under control, they need to integrate more with Latin America. So my guess is that the US, after the rhetoric, will realize that to have good economic and financial relations with the region is a key element for the US to, in a way, become a more independent country from Asia, if they want to do that.
And that's interesting. You mentioned the diversification of exports to Chile, for example. Copper is no longer its largest export. How about diversification in terms of the countries to which it exports? How much is Chile reliant on the US?
Actually, the main export partner of Chile is China. Most of the copper exports go to China, but also most of the agro-industrial exports. Chile also has become sort of an agro-industrial powerhouse in the last 50 years. Chile is one of the largest exporters in the world of grapes, of cherries, of wine, and many of those exports go to the US, go to Europe. But actually, this is very funny because before the economic reforms that Chile began in the 70s, first, copper represented 90% of exports, and most of those exports went to the US. After these reforms, the US does not represent more than 25% of Chilean exports, and copper do not represent more than 50% of total exports. So the reforms allowed Chile to become a much more resilient economy. And we have a very, very well diversified, exporting network. So we export a lot of the US, but we export a lot of Europe. We export a lot to Asia, and even we export a lot to countries like Brazil and Mexico. So we have a free trade agreement with practically all all the world. So we have free trade agreement with the US, with Canada, with Mexico, with China, with the Pacific, the Trans-Pacific agreement. We have a free trade agreement with Europe. So Chile has a very diversified exported base, but of course, China is our main client in this moment.